Hi all, welcome back to another update with Capital Clarity. I'm Christian Maloof and happy to be taking you through a weekly update. As you can see here, I'm going to start with what's been going on over the last few days, and we've got an escalating conflict going on in the Middle East at the moment. We've seen multiple bombings across the Middle East. That has caused a risk-off taste in the markets, and the opposite to what we have been seeing of late, in the fact that over the last little while we've been very risk on in the market. That's changed things. War does obviously create the unknown for many investors, and so they tend to get a little bit more conservative when that happens, and no one really knows how long the conflict will continue for. No one really knows what the economic impact will be. We've seen oil rise over the last few days, and we've just had confirmation in the media that the Strait of Hormuz has been closed, so there's nothing getting through. That's 20% roughly of the world's oil goes through that area there in terms of getting out around the world from the Middle East. That area is now sealed, and we have had reports of a ship being attacked trying to go through overnight. So ultimately what that has done is caused oil supply to start to be strained, and what that will do is demand and supply is that with limited supply becomes higher demand, and with higher demand, higher price. And we have seen the stock market also have a little bit of a negative movement this week based on the fact being that energy prices are going to be higher, and also based on investor uncertainty through a period of potentially upcoming war. Don't want to use the war word, but ultimately that could be where this is going if it hasn't started already. So looking at things, the US dollar has had a bit of upside. We've obviously been in consolidation. I've made that call in prior updates that we've been in consolidation now for the best part of a year, just under between that 100 mark on the index and about 96.5-ish, we'll call it. The opposite's happened in the euro, where we are now consolidating. We'd been going up for a longer period of time as the US dollar's been going down, and now we're consolidating once again in a region between about 119.1 and 114.9, or let's call it 115. Until either side breaks, we won't have any confirmation of what's to come. And when I say breaks, we need to see a break and a hold above those levels, or below those levels, depending on which way the euro and the USD will go. But ultimately, the longer these conflicts continue and the more risk-off we see markets, that fares well for the US dollar. And if I actually go back to the US chart and we look at the US chart over a longer-term horizon over on the weekly chart here, and if I draw a trend line here, you can see that trend line that started back on the 14th of April 2014, so it's been going for the best part of 12 years. We're now in an area here where we could get some consolidation, but you would also think that this trend line would be hard to break at that level of support that we've called out. And as you can see here, what happened back in 2020, we did see a very similar consolidation between two price points and then a push higher. So seeing that again, history repeating itself on the US dollar, and thoughts are based on movement so far, in my view, and by no means is this financial advice, but in my view, things look like they might be turning back up at this point in time. And if we continue on with a risk-off environment, that is more likely to happen than not. So if we're having a look at, once again, the USD, there is signs of strength there, but we really need to break this 100 mark and get ourselves firmly above 101 until you'd be very confident in that we're going to see that upside ongoing. Otherwise, it could just be a false move. We break back down and then we consolidate for a longer period of time. Over onto the Aussie, I've made a couple of comments on the Aussie the last couple of updates. We still haven't broken that area of resistance and also supply that sits up here at about 71 cents, 530. If I look at the weekly chart here, there's lots of false attempts. We are starting to see some risk-off environment. If that continues longer, then really I would say the more probable move would be under this sort of 69 cent support mark. I think once you break the 69 cents and we move into 68 cents and hold there, that we're more likely to go down than up on the Aussie dollar. And that probably fits the narrative in the fact the Aussie dollar has been very strong of late. The US dollar is starting to strengthen, and generally when the US dollar strengthens, the Aussie dollar would weaken. Ultimately, looking at that, I'm thinking that there's still more weakness there than strength in what I'm seeing in price action at this point in time. That could once again change. We see a big surge through the 71.530 and a hold above 73 cents. Then that would signal a really more longer term bullish run for the Aussie dollar. We did cover in the last week. I think just even yesterday with a risk-off tone, we did see that support at 69.6 tested. So it has been tested as recently as this week, and it held. So macro data in Australia is holding up, and that's probably timely for me to bring up a tool that I use called the Edge Finder, made by A1 Trading. It's a fantastic tool. And what this tool allows me to do is actually look for currency pairs that are strong to potentially on the macro side to potentially trade. So the Aussie dollar is still looking very strong. And if we go to the economic surprise index here, we can see that the US dollar sits at about 62%. The Aussie dollar is still very strong here at 83%. The Aussie dollar from a macro perspective is still very strong, and that probably is the reason why we are seeing this area really hold. So we are still continuing trying to break through here at a time where the US dollar is strengthening. In the past, if you've got risk off and the US dollar is strengthening, you're going to get a really good push down on the Aussie. And we're not seeing that. We're seeing this consolidation that we've spoken about. We're not seeing the breakout, but we're still not seeing it come down either and break out to the downside. So that macro picture, if it continues to be strong for the Aussie dollar, we might see the Aussie dollar continue to stay at that 70 cent level, maybe even go up a fraction. It's definitely what's keeping things up at this point in time, I would have thought, based on the environment we're now in. Because traditionally, in a war situation and a risk-off environment, you would see the Aussie and Kiwi not do so well. And if I jump into the Kiwi just quickly, you can see on the Kiwi, it's actually a bit of a different sign. We've seen the New Zealand dollar start to really come down. And yes, it's holding a bit of support, but there hasn't been a lot of strength there in comparison to the Aussie dollar. And most of the time, they move quite similarly. So, when you've got assets that generally move together and you're seeing a really big push down on the Kiwi in comparison to the Aussie, it does say something about the Aussie macro data that still does continue to be very strong. One thing I did want to comment on, overnight we noticed Bitcoin had a bit of a move. I did some analysis on it this morning. And as you can see here, Bitcoin has been in somewhat of a free fall since its highs back in October last year. But we did see a push up off an area of supply here just recently, back up to a resistance level. And we do have some supply further up here at about 75,552. At the moment, technically, I would still say that Bitcoin looks bearish. However, and in a risk-off environment, generally that doesn't serve well for Bitcoin. But we have seen that move up to test resistance and maybe even supply. And if we get up to that supply zone, I would say we would see a move back down. But we have now created some demand down here too on Bitcoin. And that was a rather big move yesterday that we saw. If I have a look at the total move, it was nothing to be sneezed at, 13% move. Very interested to see what happens here. I think it's got a bit in front of it in terms of resistance and supply before it gets back up into that $80,000 region. I think it's still got a bit of work to do, and an environment where potentially the stock market might continue to go down for a little while. It will be hard work for Bitcoin to really push up with any sort of gusto, but it did push up last night. We are at resistance. If we can get above that resistance and that supply level here and sort of hold above 80,000, then it wouldn't be abnormal to see a push back up to this area of supply and resistance as well at 92. So interesting times for Bitcoin at the moment. Let's watch this space. Personally, I'd be looking at a short opportunity on it. I just don't think the environment's right for Bitcoin to really do well at this point in time. That's my personal opinion, obviously not financial advice. I wouldn't be surprised if we saw a move a little bit higher to the upside to this sort of supply area at about 75.5, and then we saw that push back down something along the lines of up to here and then back down to this 64 area to retest the support. Are we done with the Bitcoin move down? I'm not sure. We are still holding a bullish momentum in terms of your larger time frame, but I still don't see enough strength in the markets at the moment to really see, and especially in a risk-off environment, I can't see Bitcoin going to any sort of massive strength at this point in time. That's once again my personal opinion, and there's also a lot in the way in terms of supply and resistance there in terms of levels on the chart. Let's watch this space and see what happens. Oil and gold, we covered that obviously there's a conflict going on in the Middle East and the Strait of Hormuz has been blocked and closed temporarily. And whilst that is the case, 20% of the world's oil supply can't get out into the world. So that's going to see supply really strained, and it's going to see demand start to win that battle. And it's no surprise that we've seen a really strong oil chart over the last few weeks. If you have a look, as far back as December was where we hit our low, and we got a very strong level of support at about $55 for WTI. And if you have a little look here, like you've got a very strong trend now to the upside and it doesn't look like at this point it's slowing down. Saw a little bit of stalling in Monday, and then it's come back, retested some support, and it's pushing back up. And at this point in time, I'm in a trade. That's why you're seeing these little boxes. I've got a couple of trades in. I had a trade from down at this level here at 67 and another trade at 70. Obviously watching this asset with interest based on the escalating tensions in Iran and the Middle East. And we jumped in, and obviously strong technicals, and we saw some strong macro data behind oil as well from the Edge Finder. And so with all those things there, I jumped in, and it's doing quite well at this point in time. Obviously news can change that quickly. If things de-escalate in the Middle East, we could see oil come back down. But we are in a bullish trend on oil. The prices have been going up for a little while. The fundamentals are behind that move, not just the war. Pretty bullish on oil, and will continue that way whilst all those things are going on, and they're all aligned. In terms of gold, gold's an interesting one. Obviously saw that really big smash down in January, late January into February, and then we saw some consolidation. We broke an area of resistance. We've come back down to test that area, and now we're slowly pushing back up. I think a little bit fueled by the fact that what we've seen in the Middle East, and obviously gold has been treated as a safe haven asset, and I think the gold could continue up until we test this area once again at resistance at 5367. The fundamentals are neutral on gold, but position of traders, the hedge funds have got a massive long position there of 159,000 contracts, very heavily exposed to gold, and at this point it's hard to see a world where gold doesn't continue up. Maybe not as quickly as we've seen in the past, but I would say that there's still probably room to the upside there for gold based on the situation we find ourselves in. And if the war escalates and goes on for a longer period of time, that will continue pretty strongly in terms of gold's bullishness. Now on to the indices. I'll bring up the ASX 200 first. You can see on the ASX we've had long-term resistance here pretty much from 29th of September last year right up until the current day, where we're sort of not being able to break that all-time high point of about 9144. We have had a strong move down through this week, and we went as far down as support here on the daily chart at 8813. Have pushed up again slightly once again to an area of now resistance. I broke that a couple of days back at 8950, and we could very well consolidate or push further down. We had quite a strong trading day on the US overnight, and so that's really pushed the strong bullish behavior in the ASX, but we're starting to see that weaker in the later parts. And no surprise if I have a look at the S&P, that today's market movement so far, whilst obviously the US has been sleeping, has been negative in nature after a fairly strong bullish move here from support. If we look at the weekly candle so far, week to date, we've got a green candle here, but we are down from highs as early as the week before. On the 23rd of February, we were in those sort of close to those all-time highs. We have pushed down. The market is starting to show a little bit of risk-off behaviour, but whilst we're holding support here at the 6806 mark, we probably would be undecided on things, and thus I've actually put in a little emoji here in my chart, because I think really to show that the market is starting to come down and that we are going to see a real bit of downside, we would need to see the $6,500 mark broken and hurled. That's for mine the key target. So this area just here, we've seen it tested back in November. Since then, we've sort of been pushing up and consolidating at all-time highs. That's the area there where I think we could start to be a little bit more bearish on the marketplace. I've obviously made my call in earlier updates that I think we could go down as far as sort of anything between sort of 13 and 23%. I think we are due a bit of a correction. Seasonality in Season X is telling me that we will get a correction based on history for the next few months. So sort of saying weakness between mid-March right up until September, October period. So if we do get that, I wouldn't be surprised we'd find ourselves sort of down in these other regions, or at very least down to sort of the 6144 mark. And if we go down as far as this trend line, the 5389. Look, at the moment, we haven't seen that. We haven't seen confirmation of that. So it's purely just some thoughts of what I think. We are seeing a market now that is very short too in terms of the smart money. We lost another 15,000 contracts over the last week, and we are now at minus 193,000 contracts in terms of our the smart money, and the smart money, I believe, is probably hedging exposure in the market that I've covered before as well. So, yeah, it's an interesting time. We probably don't have quite the condition yet where we'd see an absolute collapse or a real strong correction, but I think one might be coming. I think the market is showing us that, and there's a lot of distribution going on. Once again, it could be accumulation. So, I have been wrong before, but looking at things here, I'm definitely reading it more bearish than bullish at this point in time. And then if I just have a quick look at the Dow too and the NASDAQ, showing similar pictures, the Dow sort of has been really testing that support that we can see around the sort of 48,200 mark. Has come down a little bit. We saw our highs back in the 11th of February. So since then, it has been more bearish. So once again, we could see. I've highlighted some areas of support that I forecast we could go. One is at 9%, one is at about 16%. The Dow does move a bit more conservatively than the S&P, being a concentrated index of 30 companies. And having a look at it, we are really testing that support area. And if we break it and hold it, that could be also an early sign that the market may has reached its top for now and might be due a correction. And the last one here is the NASDAQ. The NASDAQ's been running again between two levels here. We did test that level again this week here, this 24,300 level. If we break through that and hold down, I would think around 23,800, then we could go as far, in my view, as this area here that I've got marked out at 17.93%. So interesting times as we've covered. Is this war the risk-off trigger that does bring markets down? I'm not convinced on it yet. However, my midterm thesis would be that I'm seeing more downside than upside. I keep saying it. If we do break above these highs, that would confirm we're going to continue on in our bullish ways. Have a safe week. And to those in the Middle East, we are thinking of you, and we hope that things do not escalate. Thank you very much.